Hey folks, how was your break?
Yeah.
Good, not bad. There's something counterintuitive about taking extended breaks because I obviously the extra days off are good, but you always just that extra sense of dread. It's like, oh, I don't want to go back, I just don't like at 4 days off, I want it to be 5 days off, or I want it to be 10 days off. Let's just take 365 off during the year. What do you guys say? Yeah, I'm a lot closer to that than you all are, sadly. I went to a conference with Dr. Caden on Friday. We went down to Columbia and met with other educators, and it was a very interesting story. We were the dean of or not the dean, the department chair of the Missouri State University County Department was telling some professionalism details. Now, I want to clarify this. Truman State students generally are very professional, and they operate really at a higher level than other students. And I didn't want to really kind of say that in the room because it's mostly just like saying, oh, students are better than yours. But it's telling a story about one of their top students. And this is an anecdote. I can't make this up. Apparently, this student had a job offer with one of the big four accounting firms, one of the best students in the program. It said something at a Meet the Firms event that not only got their job offer rescinded on the spot, but basically was communicated to all the other accounting firms, and the student is now working for like a small local firm in a small city because they could not get a job at any of the other accounting firms. And I'm just thinking to myself, what words can you utter out of your mouth that can have that kind of effect? So that was really kind of concerning. It's like I honestly I speak without thinking sometimes, and yet I don't think that I could come up with anything quite that nefarious. I think I'd have to really think that one through. And then again, I probably wouldn't have the courage to say something like that. But yeah, I guess if the lesson here is be very conscientious of what you're saying, especially again, if you're in front of your future employer. So yeah, that was a fun talk conversation to have, wasn't it? Yeah. So before we get started, we're gonna be talking about audit reports today. If you have them already downloaded, you'll want to access these, but I'm assuming most people don't have them downloaded. So on Brightspace under course materials, there's a link to a series of report examples that we're going to be walking through. This is something that I do want to reiterate. It's very important. Every single time I give this exam, I always have a 12-point problem, a 12-point question, which 12 points doesn't sound like much, but remember, it's only 60 points. So we're talking 25% of the exam. That's right now, right? 20% of the exam. 20% of the exam that will basically be an audit report, and you'll have to tell me what's wrong with it. All right. So this is going to be a very important detail. And I realize that that's really not fair because that requires a lot of understanding of the audit report. And you say, well, Dr. Barnes, that's not fair because we'll have access to this in Google and we won't have to learn this. If it's something that the CPA exam tests on, then it's something that I'm going to test on. And that's kind of my criteria for this course. So you do need to have a very thorough understanding of the report. The good news is we're going to spend a lot of time talking about it, but you'll want to focus very heavily on this because if you understand it really well, that's 20%, 20% of the exam you know that you can conquer. If you don't understand it very well, that's 20% of the exam you can throw away. So what is my level of understanding? It's pretty detailed. So let's go ahead and get into it. So we've talked about how to conclude the audit. We talked about that last Wednesday. Now we're ready to issue the opinion. And we're going to talk about the different types of opinions and what the changes are. But we're going to start out. What we're going to do is we're going to talk about the standard unqualified audit report. Now we're going to focus just on the PCOB report. There's a whole different sequence of reports for the ASB for the private issuer audit. They're actually longer and more complicated, but they have common elements. So we're going to start out simple, and if you all endeavor to move on to graduate auditing and join me in the graduate program for seminar and auditing, then we can wrestle with the other reports. Suffice to say, if you're planning on sitting for the CPA exam, you will need to have an understanding of both. But we're going to start with the easy one. And you're going to say, this is the easy one, Dr. Barnes? I say, yeah, believe it or not. Yeah. So let's talk a little bit about what's contained in the very basic report. So this first one we're going to talk about is the clean opinion. When I say clean opinion, this is the unqualified audit report. And then once we have that down, we're going to say, what do we change from this report when we modify our opinion, when we adapt our opinion, we change our opinion. So first of all, we're going to talk about the 8 common elements that are in the reports. Now, I'm going to list 8 elements out here, and if you know these 8 elements, that's probably sufficient to get 6 out of 12 points. So this is going to be some learning, but this should not be the only learning that you do in this area. So the first part is going to be the report title. It's going to say at the top what the report does and what it's about. It's very, very explicit. We'll look at that in just a second. Second one's going to be the addressee. Now, since this is a public company audit report, this generally is going to be addressed. In fact, I don't think I've ever seen an example otherwise. This will generally be addressed to the shareholders and the board of directors, okay? Shareholders and or the board of directors, I should say. So this is one that's available to the shareholders. Next is going to be the opinion, which if you are one of those people who likes or doesn't like spoilers, this is kind of basically a spoiler for the rest of the report. They put the opinion at the beginning. This is a change that they've actually done over the past decade. Used to be the opinion came at the end after all the other information came. Now the opinion is very, very front and center. It says, here's our opinion. This is what you came here for. Next, we've got something called the basis for opinion section, okay? Now, the basis for opinion section contains three fundamental parts, okay? Three fundamental parts. There's two paragraphs. The first paragraph is about responsibilities. Now, we've talked about different areas of responsibility, okay? We've talked about two different areas of responsibility. We've talked about management responsibility and auditor's responsibility. The first sentence of the first paragraph is about management's responsibility. That's it. One sentence on management's responsibility. The rest of the first paragraph talks about the auditor's responsibility. Then the second paragraph is something called the scope paragraph. Now, remember we talked about scope limitations earlier on in the semester? Scope limitation was an auditor can't do their job. Scope by definition then means this is the job that the auditor is doing. This is what they did over the course of the audit. That's what the scope paragraph entails. Then we have a section called critical audit matters. Critical audit matters, which we're going to talk about in a little bit more explicit detail here in just a second. Okay. Then we have the name and signature of the auditor. So we'll have the name of the auditor as well as signature. Now, it's important to note that the signature can be taken in a couple of different forms. If we're talking about an accounting firm, usually the signature is going to be of whoever the partner is for the firm, or it can actually be of the firm itself, but basically some sort of written description of whatever the firm is, the auditor is. We have something called auditor tenure. Has anybody heard that term tenure before? So tenure basically means how long you've been with an organization. Auditor tenures are reporting on how long that it is. This actually has a lot to do with independence of the auditor. If they've been there for a long time, there's some independence concerns. As we're going to see in our example report, Willis and Adams has been the auditor for Earthquake years, going on 50 years. So it's a very, very long-term engagement. Then we have the location and the audit report date. So where the audit was conducted and when the audit report was issued. So we'll come back and look at this in just a second. We're going to allude to each of these points, okay? I do want to talk about this thing called critical audit matters before we get into the example report. So what are critical audit matters? Critical audit matters, or as we're going to call them CAMs, okay, are matters arising from the audit that are communicated or required to be communicated to the audit committee. So basically there are three criteria. The first criteria is not numbered. It's something that has to be communicated to the audit committee or has already been communicated to the audit committee. So what needs to be communicated to the audit committee is basically this information. This information relates to items that are material to the financial statements and involve complex or subjective auditor judgment. So material and subjective in nature, basically what it is. Something that has to be communicated to the audit committee that's material and subjective in nature. It's easier. So the reason I present it in this way is like, why don't you just do a number that's 1, 2, and 3, Dr. Bartz? Because this is the actual language that's used in the audit report, this up here. They label it saying this is audit committee, and then they do numbers 1 and 2. This is how they present it. But technically speaking, this is 3 criteria, okay? 3 criteria is going to be audit committee communication, material to the financial statements, complex or subjective judgment. And just because I had some space, I put in different pictures of cams. These are not the cams I'm talking about here, okay? It's not a webcam. It's not Cam the singer. I didn't even know Cam the singer existed when I made these slides. It's not Cam Newton. It's not cam shafts, okay? Critical audit matters. By the way, they do have also, they have CAMs for international reporting as well as ASB reporting, but they're called KAMs, key audit matters, okay? There's a little bit of story behind that. We're not going to worry too much about it, but that's kind of very similar in nature is they report same context, same pieces of information. All right, with that, let's go ahead and take a look at the standard unqualified report. So remember, we said our first items, so this is the first page of this this document that I told you all to look at, all right? And if you don't have access to it, it's fine. I'm going to load it up here. But this is our basis. This is our basis for reporting. We're going to say, let's learn this document, and then we'll make adjustments based on that. Okay. So what did we say the first item was? We said at the very top, there's going to be a report title. So the report of independent registered public accounting firm. There's our title. All right. Second item, we said the addressee to the shareholders and board of directors of Earthware Clothiers. It's kind of standard language for that. Then we have the opinion. And you'll notice the opinion here is pretty straightforward. It talks about what they did. And they said, what was their opinion they reached? In our opinion, the financial statements present fairly in all material respects the financial position of the company December 31st, 2025 and 2024. So there's a couple of interesting points to note here, okay? First of all, this is an unqualified opinion, which basically unqualified by definition means everything is fine. We did not find any material misstatements. We did not have any scope imposures on our audit. So everything is good. We're happy with the financial presentation. Also, you will notice that they present multiple financial statements. They did not audit 2024 this year. They audited in a previous year. But we present this on a comparative basis, as many financial statements are. Has anybody ever looked at a 10K before? Financial information in a 10K is usually presented 1 or 2 or 3 years comparatively, so that you can actually look at it on a comparative basis. Now, this is going to present an interesting issue, because this is effectively saying, look, we audited the information in 2025, but in previous years, we audited 2024, and we also had a clean opinion in that year. We had an unqualified opinion. So your question is going to come up, what happens if there's something other than a clean opinion in one of those years? And I'm going to say, that's a good question. Let's hold off on that until we get a little bit later in the lecture. All right, so here's our opinion. And then in green down here, we've got this paragraph right here. The reason I put this in green is this is something that will be a pretty standard inclusion in most audit reports. This is about internal controls over financial reporting. Does everybody remember chapter 7? We had to test internal controls over financial reporting. We have a separate report for that thankfully we're not going to worry about for this particular course. But this paragraph right here is something called an explanatory paragraph that says, we also audited internal controls over financial reporting. You should be aware of that. I'm not going to include this in other versions of this report simply because it just takes up space and the language is pretty much the same. But keep in mind that for most of our paragraphs on internal control, or most of our reports on financial reporting, we would include this paragraph as well, because this would be something that would be a standard part of the financial statement audit for a public company. But the reason I put this in green here is just to keep in mind that this should probably be in all the other reports too. I didn't include it in the other reports. All right, basis for opinion. Now, what did I say? The first paragraph is about responsibility. First sentence about management responsibility. That these financial statements are responsibility of company's management. Boy, that sure seems like a letdown. It sure seems like there should be more words there, shouldn't there? Yeah, but that's the sentence we get. That's management's responsibility. Everything else is audit responsibility. So everything that says our responsibility is to express an opinion on this financial statements audits. Who are we? We're a firm accounting. We're registered with the Public Company Accounting Oversight Board. We're required to be independent, which we'll talk about independence a lot on Wednesday. And we're in accordance with the federal security laws and applicable rules under the Securities Exchange Commission and the PCAOB. By the way, the PCAOB is the one who sets the auditing rules, but they are a subset of the Securities and Exchange Commission, which is why that's mentioned in this particular document. Then we said this is what? This is the scope paragraph. This is about all the tasks that the auditor performed. I'm not going to go through this state by statement, but basically it's a very general depiction of what happens over the course of the audit and what the auditor's initiatives are with respect to the audit. So this details everything that we do. If we can't do these tasks, that's where we start thinking about those ideas of scope limitations, okay? Then we have this thing called critical audit matters. Critical audit matters, remember I said that there's a reason I present it as this, having 3 criteria, because this is the exact language that was in the slides right there. So critical audit matters communicated or must be communicated to the audit committee, relate to accounts or disclosures that are material to financial statements, and involve challenging, subjective, or complex judgments, okay? Then you can get a look at an example of critical audit matter. By the way, this is the first course ever that I've actually included an example critical audit matter. Okay, so you guys are special, all right? You guys are special. You're more special than previous classes. You can tell the students from previous class I said that. Okay, obviously I decided to want to be a little bit more thorough in that, so I made some changes to the whole audit reports. But you guys are special. Anyway. So an example of a critical audit matter might say, look, we think IT systems and controls, this is a relevant point of the audit, an area where we expended several resources. If we, as part of the audit, we think this is a material part of the financial statements. So it involves complex and subjective judgment that we need to talk about. So we talk about what it is that's a critical audit matter and what we did over that area. Now, for the most part, this is not going to encompass everything in the audit. In fact, it shouldn't. This should be only the most important points, which I think we can agree that IT system and controls, that's an important point of any organization. Usually this is going to be limited to one or two items, one or two areas of a particular emphasis. If it's a lot more than that, then that's getting a little bit out of hand. But we'll see. This is kind of an example of what we would expect to see here in this area. Then we have name and signature. I even went so far as to put a signature up here for you guys. We have served as company's auditor since 1975 in Boise, Idaho, February 15th, 2026. So we got our name and signature of the auditor, the tenure, and the location and audit report date. All the elements we talked about. Now, again, how well should you know this? Do you need to memorize this? Well, first of all, I'm going to tell you right now, you don't need to memorize the wording in the critical audit matters because that's not supposed to be boilerplate. It's supposed to be engagement by engagement basis. This is just for your reference. As for everything else, it is fairly boilerplate. Does everybody know what I mean when I say boilerplate, by the way? Boilerplate means standard. It's kind of language that's used consistently over and over again. So if you were to look at this and if you were to memorize this word for word, is that going too far? Maybe, okay, may affect your sanity, but it would be a good approach for understanding everything that's in the report. By the way, when I sat for the CPA exam, that was pretty much the standard they operated with, is they'd memorize the audit report. Why don't they encourage that now? Because there's so many freaking audit reports that it's impossible to memorize them all. So they don't say memorize anymore, but I would understand the language very, very thoroughly and be able to identify gaps in the language. This is our standard. This is going to be what we're going to be operating to start with, and we'll talk about the adjustments to that because there's a lot of different ways that we can present it. All right. So moving on to this concept of the standard unqualified report, we can make changes to the report without changing our opinion. What do those entail? Well, first of all, that's going to be called explanatory language, okay? And this is basically just adding additional language to the audit report, and there's two different scenarios that we could talk about. First is modified wording, which is adding explanatory language to existing paragraphs. And the second is an explanatory paragraph itself. We've already seen an example of this. That was that paragraph in green that I was showing you for the audit over internal controls over financial reporting. That would be an example of an explanatory paragraph. So hang on, there's a lot of stuff going to the next slide, and not all is covered in the slide. So I expect you to take notes on this one. So for modified wording, generally speaking, there's only going to be one scenario that we will use modified wording. And that is going to be an opinion based in part on the work of another auditor, on the report of another auditor. So for really large engagements, we might split up the responsibilities with another auditor, particularly if it's a big geographic audit. Think about a company like Walmart or Amazon. They operate on a global basis. So we probably can't do all the auditing work ourselves as a company. We need to rely on other auditors to do some of the work at other locations. If that's the case, we're doing work that relies on the work of other auditors. We have two choices in that scenario. If we're the primary auditor, we can either say, we accept the judgment of other auditors. If that's the case, then everything's fine. We can take responsibility for that, which means we also take liability for their work. What if we say, look, we think they've done a fine job, but we're not willing to take responsibility for their work? If that's the case, that is when we're going to add the modified language. That is when we're going to say, based on our work and the work of other auditors, we're going to change the language slightly based on our work and the work of other auditors. Where does this language go? It goes in the opinion paragraph. Also in the basis for opinion section in the auditor's responsibility. So we're going to change the wording in the opinion paragraph to reflect the fact that based on our work and the work of other auditors, we're also going to use similar language in the basis for opinion section, specifically the auditor responsibility paragraph. And then for PCAOB reports, they require that we also add an additional explanatory paragraph, as if the other two sections weren't enough changes. We have to explain that there was work done by another auditor whose work we were relying on. So three big changes for the PCAOB reports: the opinion section, the basis for opinion section, and the explanatory paragraph. Now, the reason I mentioned for the PCAOB report is that ASB has similar criteria, but it doesn't require the inclusion of an explanatory paragraph. It's just modification of the wording within the report itself. A lot to go through, and we're only one line into the slide. Okay, so what else we got? Explanatory paragraph. There's a lot of scenarios where explanatory paragraphs can come up. So the first one is pretty straightforward. We've already looked at this example. An audit of internal controls of financial reporting for other public companies. Keep in mind, this paragraph does not substitute for the report that you have to issue as an auditor over internal controls over financial reporting. It merely refers to that testing being performed. So that paragraph in green is an example of this type of paragraph that we would add. What are some other examples? Another example is something called going concern. Does everybody remember the term going concern? We talked about that on Wednesday. If we believe our client may have trouble moving into the future, they may not be in business in a year from now, we have a responsibility as auditors to add an explanation of that into our reports. What did I say was really important to emphasize with respect to this paragraph and the opinion being rendered? Does everybody remember? I said that the opinion, the issuance of a going concern statement, issuance of substantial doubt does not change the nature of the opinion, okay? So even if we think that there's substantial doubt about their entity's ability to continue as a going concern, that doesn't affect the opinion that we're going to render. Now, again, just as a reflection of what we talked about, if our client fails to treat this situation properly, because remember, management also has to disclose this information in the financial statements. If they fail to do so, that is a departure from GAAP. That would affect the opinion, okay? But assuming that our client has done everything properly, they've reported the information properly, the existence of a going concern issue does not change the opinion that the auditor is rendering, okay? Assuming that the client has done everything properly. Next, we have this thing called a lack of consistency. And I want you to make a note here. When we talk about consistency, we're very focused on the idea of comparability from period to period. Now, this is a little bit subjective. This is a little bit tricky. Most of the time, we're going to follow financial accounting rules for actually how we evaluate consistency and comparability. What do I mean? It means that if we have a change in accounting principle, a change in reporting entity, a correction of a misstatement in previous issued financial statements, based on what you learned back in 303, how do you treat those particular changes? Is it retroactively or prospectively? Give you hints. The one that begins with an R. Retroactively, we have to go back and we have to restate the financial statements. So we have to go back and restate the financials. In retroactive situations, we also, as auditors, have to add an explanatory paragraph because we're going to say, look, going back to the previous period, you are not going to be able to compare that to the current period as effectively because it's changed from what it was. We changed the financial statements. So any retroactive adjustments are going to require that explanatory paragraph. Why am I being so hard on this? Well, what about this thing called a change in accounting estimate? How do we treat that? Is that retroactive or prospective? That is a prospective change. Like if we change depreciation useful life, we're just going to use the new useful life moving forward. We're not going to go retroactively adjust depreciation estimates from the previous period. So does that affect consistency? Not really, not from a financial accounting perspective. Does it affect comparability? It could, okay? You will see scenarios where the audit textbook will say, this does not require an explanatory paragraph. You will also see scenarios where the audit book textbook says, this will affect comparability. You will require explanatory paragraph. So how do you tell the difference? What are the two words that we always talk about in accounting? It depends, okay? It's a very, very subjective judgment. If you think it will affect comparability as an auditor, if you think that comparing the current period to the previous period is not a fair comparison because of the change in accounting estimate, then you would issue an explanatory paragraph, okay? This is the one that's not a really clear, bright line criteria. These first three, absolutely, you would have to include explanatory paragraph. This last one, all right, it's inconsistent. It's inconsistently used because the situation, it's dependent on the situation. The fifth scenario, a justified change in accounting classification. So we change something from short-term debt to long-term debt because we think that's a proper justification. Keep in mind that's going to affect the user's interpretation of that information from a previous period. So that would be an example of that. By the way, do you need to remember all these? I'm probably not going to change or test those on too clearly. If I do, it would be a multiple choice question. So you don't need to memorize each of those. But keep in mind that this does closely resemble what you learned from 303 about retroactive versus prospective adjustments. All right, what is the final thing that might require an explanatory paragraph? This is kind of a cop-out, but it's anything else that requires additional emphasis. So basically, any change that we want to issue an explanatory paragraph for, but does not require or does not conform to one of these three areas. So basically anything could require an explanatory paragraph if we think that it's necessary to include an explanatory paragraph. Like I said, those two words come up again. It depends on the situation. All right. So explanatory paragraphs do not change the opinion being issued. They do not alter the opinion being issued. But as we know, there are different types of opinions that can be rendered. So what happens? What are the situations in which we're going to issue a rendering opinion? So we're going to talk about this now. If we talk about immaterial differences, we're always going to issue an unqualified or unmodified report. And that could be any variant of those of an unqualified report. It could be the basic language. It could be an unqualified report with explanatory paragraphs or with modified wording, depending on the scenario. What about the other types of reports? Well, we need to talk about 4 different scenarios. And I know you're saying, Dr. Barnes, we only talked about 3 different types of opinions that could be rendered, 3 other opinions. Keep in mind that one of those opinions can be rendered in 2 different situations. So we've got our qualified opinion. And if you remember this all the way back from chapter 1, I said qualified opinion can arise in one of 2 situations. A departure from GAAP that is material but not pervasive, or a scope limitation that is material, not pervasive. So a departure from GAAP is the client did not follow accounting rules. All right. Client did not follow GAAP. They did not follow GAAP, and because of that, their financial statements are materially misstated. Scope limitation says the client did not allow us to do our job. We were not able to, not even that the client did not allow us to do our job. We were just not able to do our job. That may be client imposed limitation. It could be a non-client imposed limitation. So whatever it might be, whatever it was, we could not do the job effectively. And because of that, we have to change our opinion because we don't know what's going on. All right. Both of those are possibility at the qualified opinion. And we're going to look at a qualified opinion for both of those types. Then we have our pervasive situations. These are extreme opinions. The first of these is adverse. Adverse basically says that there is a pervasive departure from GAAP. The financial statements are so materially misstated that we have to say they're not free from material misstatement. It's the exact opposite of what we'd like to say. Are the financial statements free from material misstatement? No, the opposite. They have very material misstatements. Okay. This is basically a pervasive departure from GAAP. The client so badly didn't follow the rules that the financial statements are all out of whack. Then we have a pervasive scope limitation, which is called a disclaimer of opinion. Our scope limitation was so severe that we legitimately don't know. We can't issue an opinion. We can't issue an opinion because we were not able to do our job. A little bit like saying that you need to go in and you need to do something, but you can't actually enter a room. So you have to go, say you're a janitor, you have to clean an office, and then you go to the office and the door is locked. Can you charge for those services? Probably not, because the room you were assigned to clean, you were not able to get into. That's the kind of thing we're talking about for a pervasive scope limitation. Also, I did mention this very briefly, but I want to mention it because it might come up. There is another possibility for a scope limitation or disclaimer of opinion. It will never happen in a PCOB audit report because it's required, or because this is required for PCOB opinions, but it might happen in an ASB report. You issue a disclaimer of opinion if you are not independent from your client. So you perform the audit, but you have a pre-existing relationship with your client. You can't issue an opinion in that scenario. Now, again, this will probably not come up, may come up in homework, but in a PCOB opinion scenario, we have to be independent from our client in order to be able to perform the audit. That's a requirement. All right, everybody ready? All right, let's do this. How do the reports change if we're issuing an opinion? So we all got this one down right now. Has everybody spent the last few minutes memorizing this report? You know it word for word now? Good. All right, that's what I was expecting. So let's talk about what the changes are. Now, the good news is the qualified opinions don't change that much. There's a few small changes. So what were the 2 words that were really important for qualified opinions? Except for, that's what we're going to be looking for. So you will notice the opinion does change, and it changes exactly what we talk about. In our opinion, except for the effects of not capitalizing certain lease obligations as discussed in the following paragraph, and then everything else remains the same. So we add basically a kind of a clause in there that explains the one reason that we're just changing our opinion. Except for this one issue, which is relatively minor. It's material, but it's not pervasive. Everything is good. That's the nature of a qualified opinion. You will also note that there's this big paragraph in red. This big paragraph is a required part, and this is true for any opinion other than unqualified. We have to explain the reason for our departure, the reason for our change in opinion. This big paragraph, this is not boilerplate, by the way. This is not a standard paragraph. This is specific to this scenario. This is an example scenario that I copy and pasted from some outside source that says, here's what we would get if we had a qualified opinion due to a departure from GAAP. It's probably important to note. This is a qualified opinion, but it's specifically for a departure from GAAP. And there will be some changes, some differences that we'll have to note there. And that's it. There's no other red text in here. There's no other red text, so everything else remains the same. We don't make any changes to other parts of the report. That wasn't too hard, was it? 2 changes for the qualified opinion. Okay, we're going to change the opinion section. We're going to add a paragraph that explains the reason for the change in opinion. Now we have qualified opinion due to a scope limitation. Okay, qualified opinion for scope limitation. As you can see, we got a red italicized text there. I came to understanding, by the way, several years ago, because I thought I was being really clever by doing colored text. But then it came to me, it's like, well, what if you're colorblind? So, oh, well, that's an accessibility issue. So even if you can't, if you do have the accessibility issue, it is kind of italicized and bolded here as well. So there's a distinction in that regard as well. But that's something that I didn't pick up on, which, yeah, I apologize for that in that scenario. But anyway, the red italicized bolded text is the additional text. So, except for the expected adjustments as any, it might have been determined to be necessary, I would have been able to examine evidence regarding the foreign affiliate investment accounts and earnings as described below. So, this is a scope limitation. It's going to explain what we were unable to do as the auditor, except for this one thing that we could not perform because we could not get any information on, therefore we cannot issue an opinion on it. Everything is good. And then we've got this other paragraph that says, here's what our scope limitation was. We were unable to obtain an audited financial statement supporting the company's investment in a foreign affiliate. So we could not look at this foreign affiliate. This foreign affiliate we believed is at least a material component of the financial statements. Therefore, that is why we issued the qualified opinion. So that's 2. That's very similar to the qualified opinion, but I'm going to throw a little curveball at you. There's a third one, okay? And it seems really, really nuanced. You're going to say, Dr. Barnes, would you really test on that? Yes, nothing is beneath me, okay? What is the other item? If you look down here in the scope paragraph, there's 4 words, except as discussed above. Now, are those words really necessary? Like if I asked you about that, like, would I possibly give you an example in this and say, have you identify the except as discussed above? Absolutely. Why is that so important? So remember, this is called the scope paragraph, right? What was restricted or what was limited in this particular scenario? Our scope, okay? We could not do our job the way that we're supposed to do it, so we need to specify in the scope paragraph, we're not able to apply these procedures in this one scenario. So you need to be aware that this one scenario, the statement is not applicable. So the statement, even though it's only 4 words, it's really important to include in the discussion. So we have to include there. That's it. There's the three changes there. So the same changes as we saw in the qualified departure from GAAP. We also see qualified for scope limitation plus an additional 4 words down here except discussed above. All right. So that's pretty good. So that's all that really changed. Now let's talk about an adverse opinion. Now, what is the characteristic of an adverse opinion? Adverse opinion is a pervasive departure from GAAP. In other words, we're saying the financial statements are not free from material misstatement. And that's exactly the wording we're going to see in the opinion paragraph. Because of the matters discussed in the following paragraphs, the financial statements do not present fairly in conformance to accounting principles generally accepted in the United States, the financial position of the company. Okay. So instead of saying the financial statements presented fairly in all material respects, we say the exact opposite. We change our wording to say the exact opposite. Now, I do want you to note that the wording order is a little bit different here. I won't test you on specifically on the wording order, okay? I would expect you to identify that there's certain language characteristics that would be identified here, but you don't need to memorize that the wording order has changed a little bit here, because I do believe that they talk about generally accepted accounting principles at the end of the paragraph in the unqualified opinion, but they mention up here in the adverse report. All you need to be aware of is that language needs to be changed to say financial statements do not present fairly. Also, there's paragraphs down here that explain the nature of the adverse opinion. Now, This always comes up because students are very diligent, but I do want to clarify this. Are two paragraphs required for an adverse opinion versus one paragraph only in the qualified opinion? The answer is no, okay? This just happens to be the example that I pulled for this particular scenario. There may be a scenario where we would see two paragraphs in a qualified opinion, depending on the nature of the deviation. There may be a situation where you only need one paragraph for the adverse opinion. This is just purely coincidental, simply because of the nature or that example that I pulled. The number of paragraphs is arbitrary. It really depends on the situation that we're dealing with. Okay, so we could have 3 paragraphs here, 4 paragraphs here, whatever the auditor deems necessary. The number of paragraphs is not restricted here, but we would have to explain the nature of the deviation. Okay, the nature of the deviation is explained down here. All right. Basis for opinion does not change. Scope limitation, or sorry, scope paragraph does not change. But then we get down here to critical audit matters, and there's a whole bunch of strike through text right there. What does that kind of apply to you all? They go away. We get rid of it. We get rid of the critical audit matters. Why do we get rid of critical audit matters? The answer is because we've identified a critical audit matter already above, and we don't want to conflate that with the problems that we would talk about below, or the issues that we talk about below. We want the focus to be on what are the issues that resulted in an adverse opinion. That should be the area of focus, not the critical audit matters that we would identify otherwise. That's the reason the critical audit matters go away. We get rid of those altogether. So not too bad, not too bad. 3 changes to this report. We have to change the opinion. We have to add the explanation paragraphs, not explanatory, but the explanation paragraphs to the reason opinion, and we get rid of critical audit matters. All right. So everybody feel they got a grasp on this? This is not too bad, right? Okay. Disclaimer opinion. Okay, before we get to disclaimer opinion, let me give you a little bit of a hint. A disclaimer of opinion is just a full out disclaimer by the auditor. We cannot render an opinion. So anything that refers to the auditor rendering an opinion has to be changed, has to be either changed or outright eliminated. So when you see something that refers to the word opinion, we're either going to say disclaimer of opinion, or we're just going to get rid of that reference altogether. And it leads to a very messy report. How messy? I'm glad you asked. First thing, you will notice that in the opinion to the audited financial statements, it's not the opinion, it is the disclaimer of opinion. Because remember, we did not issue an opinion, we're disclaiming that responsibility. Also, the first words in the paragraph, first opinion paragraph says, we have audited the financial statements. If you disclaim an opinion, did you audit them? No, you didn't. You weren't able to audit. That's by definition what a disclaimer opinion signifies. We were engaged to audit. We tried to do it, but we couldn't. Okay, so we did not. It's not we have audited. It's we were engaged to audit, and then we explain in the below. We changed our opinion. Technically speaking, we don't change our opinion. We just don't render one together. Okay, so you can see what the language says. We were not able to obtain sufficient appropriate audit evidence to provide a basis for opinion in the financial statements, and we do not express an opinion on these financial statements. So that's what we're disclaiming. We're basically saying, yep, couldn't do our job, no opinion, sorry, pay us. Yeah, we don't actually put the pay us in there, but they still have to pay us. And then we explain this. We explain the reason for it, what it is that we get in. We tried to look at inventory because it's a big part of the financial statements. We cannot look at inventory. As a result, we feel that the financial statements are materially pervasively misstated, or could be materially pervasively misstated, but we don't have evidence to support either conclusion. Okay, we don't have evidence to render that. So then we have the basis for disclaimer of opinion, because remember, it used to be basis for opinion, but this section is now changed to the basis for disclaimer of opinion. We have the financial statements, the responsibility of company's management. All responsibility is to express an opinion on the financial statements based on our audits. But that's bolded and strike through. What's going on here? Well, it says that's our responsibility, but we didn't issue an opinion. We're giving up that responsibility. So it doesn't make sense to include that sentence anymore. Would I possibly test you on the exclusion of that sentence? Again, yes. Okay. I'm a stickler for this. Okay. Stickler for this. So we get rid of that sentence altogether. And then you'll notice this thing right down here is all struck through. It's all struck through. What was this paragraph called again? What type of paragraph? Scope. If it's a disclaimer of opinion, what was limited? Our scope, okay? So our scope was limited to such a degree that we no longer can report on what we did the work on. We don't report on that work anymore because we couldn't do it, all right? Also, remember critical audit matters? They go away as well, okay? So let's just summarize. Title of the opinion section changes to disclaimer opinion. We changed the first words in the opinion paragraph to "we were engaged to audit" since we have audited. We changed the opinion. We explained the change of opinion. We add basis for disclaimer or disclaimer up to basis for opinion to basis disclaimer opinion. We eliminate the second sentence because we didn't express an opinion in this scenario because we're disclaiming that. We get rid of the scope paragraph. We get rid of critical audit matters. But other than that, everything else stays the same. Okay. Is that a little bit intimidating? Good. I have you right where I want you. You shook your head, Michael. You're not intimidated at all? Oh, come on. Okay. Well, good for you for being optimistic, being positive. All right. So that's the crux of this particular chapter. All right. That's basically what your focus should be on. But we do have a few more slides I want to talk through really quickly in our last 10 minutes. So really quickly, I'm going to skim through these slides because these are not as important, but what do we mean by pervasive? Okay. We've talked about this idea of pervasive already. Describe the effect of a potential scope limitation or departure from gap in the audit report. What are they? They're not confined to specific elements of the financial statements, so they could actually be broadly encompassed out throughout the financial statements. They can be confined to a specific area, but that's a substantial portion of the financial statements. Okay, so an example of this, if we were not able to audit any inventory in earthware clothiers, would we say that would be a pervasive scope limitation? Yes, they're a retail company, a retail inventory company. So not auditing inventory is a real problem. Okay, so that would be an example of a pervasive scope limitation. Or if the financial statements were misstated, but only misstatement is inventory, that might represent a pervasive departure or a pervasive misstatement. Also, with regard to disclosures, they're fundamental to users' understanding of the financial statements. So say that we have a massive subsequent event, okay, that is required to be disclosed, a massive disaster, like one of the factories was destroyed, which people would probably hear about it on the news, but the client refused to report this in the financial statements. Are they required to do that according to GAAP? Yes, subsequent events are required under generally accepted accounting principles. If it was significant enough and might affect users' interpretation of the financial statements enough, we would say as auditors, look, this is a pervasive departure from GAAP. Numerically speaking, it doesn't affect the financial statements, but it's such a big part that it would affect the disclosures that you do need to include. So that would be an example of a pervasive departure from GAAP with respect to disclosures. Some other special reporting issues we might run into with reports on comparative financial statements, which I mentioned we were going to talk about. Any other information and documents contained in the audited financial statements and special reports. So let's go through this pretty quickly. On comparative financial statements, remember, we present the financial statements on a comparative basis. But what happens if our opinion in the current period is not the same as the opinion in the previous period? Basically, all we do in that is that our audit report, we reflect both opinions in the audit report, okay? We would say in 2024, we issued a qualified opinion. Our opinion for 2025 is an unqualified opinion. We do need to clarify that the opinions that we render, if they're inconsistent with one another, what they are for each year. That's all there is to it. We can't say we presented an unqualified opinion for both years if they were not both unqualified opinions. Also, predecessor auditor. What about the predecessor auditor? If we're not the first, this is our first year auditing and we're using the work of predecessor auditor, what do we need to do? Well, we need to have the predecessor auditor read the current period financial statements, compare the prior period and current financial statements, and they need to obtain a representation letter. Now, what is a representation letter in this context? A representation letter is a letter from us as the current auditor to the previous period auditor saying we will not misuse the information that you're providing to us. We are basically asking their permission to use their work so that we can present on a comparative basis. So they did the audit in the previous year, they came up with an unqualified opinion. We're doing the audit in the current year, we also came up with an unqualified opinion, but we didn't audit the previous year. So we're asking for their permission to use that representation. That is what the representation letter means. What about audit other information contained in the audit financial statements? So beyond the financial information presented, the auditor has no responsibility for information contained in annual reports, registration statements, and the like. So here's a picture of McDonald's annual report. Does that look like a 10K to you? No. So that is, first of all, that is the best looking Big Mac I've ever seen. And I used to work at McDonald's, okay? I worked at McDonald's as a teenager. I never made a Big Mac looking that good. That was definitely some modeling that was done there to make it look perfect, okay? I would eat that Big Mac. That's how good it looks, okay? Anyway, and I dislike McDonald's very thoroughly right now. So anyway, yeah. So 10Ks, very, very business, very organized, kind of a very, very monotone color. Annual reports are sunshine and rainbows. They're trying to put the best spin on the organization and make it look good. So what does the auditor have to do with information like that? They have to read the other information and they have to consider whether it's consistent with audited financial statements. In other words, we are not auditing any information that's putting in there, but if they use information that we have audited, we have to make sure that information is correct. They can't say that $1 million loss was $1 million profit, even though they try to fudge the position of the organization in the annual reports. Again, the annual report is a depiction of the organization in the best possible terms. They have to be honest with respect to the audited financial statement. And we're going to be consistent with that in our reporting. We're going to read that information to make sure that information is consistently used. What about special reports? We've got a few different areas with respect to special reports. First of all, financial statements presented on the basis of accounting other than GAAP. They can exist, okay? Can we audit on specified elements of accounts or items of financial statements? The answer is yes. What about audits over compliance? Those exist as well. We're going to talk a little bit more in detail about those on Wednesday. But special purpose frameworks are basically when an auditor prepares their financial statements on a basis other than GAAP. Most important note here, this will never exist in a PCAOB audit. Clients are required to report under GAAP under PCAOB audits. Now, that doesn't mean that all companies who are registered to sell stock in the United States are under GAAP, because we do know that IFRS companies can do that, but usually IFRS companies are audited under IASB standards, all right? If it's going to be a PCAOB sanctioned audit, it has to be under generally accepted accounting principles. That being said, other companies, smaller organizations, private companies, they can use whatever framework they want. Regulatory basis, cash basis, modified cash basis, contractual basis, tax basis. So all these bases are certainly requirements. All we would do in reporting for this is we would make sure that we perform the audit based on what we know the reporting framework is, and we'd issue our audit report on the basis of that framework. So it would no longer be on the basis of generally accepted accounting principles, but on the basis of whatever the framework that's being used in that context. Also, an auditor may be engaged to report on specific parts of financial statements, or when reporting on specific elements, accounts, or items, they may be applied agreed upon procedures. Now, I want to put a pin on that because we're going to explain agreed upon procedures in more detail on Wednesday. Basically, the way you should think about this now is this is an engagement that is substantially less in scope than an audit. Okay, an audit has very specific rules and requirements that be performed. If we wouldn't want to go that much in depth, then we could go to agreed upon procedures. But for right now, let's just leave it at that. Also, for compliance engagements, the regulatory requirements, et cetera, the auditor provides negative assurance regarding the auditor's compliance with rules and provisions. So there's two things that we want to talk about with respect to that slide. And I'm rushing because I want to make sure I'm done, but this is the last slide so I can take my time. All right, so first of all, when we talk about compliance, remember, compliance in this context refers to laws and regulations. So what are the rules that are related to the industry in which the organization operates? Can we as auditors perform an audit over compliance? And the answer is yes, okay? We're no longer testing specifically the financial statements or the controls, but we're testing compliance with the requirements of the provisions of this organization. So what are the industry they operate in? But when we perform an audit of this nature, we encounter this thing called negative assurance. Now, how do we contrast this to what we already know? When we issue reasonable assurance, we consider that to be positive assurance. We are saying we're positive the financial statements are free from material misstatement, okay? We're providing reasonable assurance that the financial statements are free from material misstatement. Negative assurance is first of all, it provides less assurance. It is a lower level of assurance. It is not saying that we are positive about something. It is saying that we did not find something that might cause problems. So negative assurance is basically saying, instead of saying the financial statements are free from material misstatement, it's saying we did not find any problems that exist. That's a less strong statement, I guess. So it provides less assurance in that statement. The reason I bring this up is that we're going to encounter negative assurance in many contexts a little bit later. Some types of engagements only operate on negative assurance, so we don't provide higher levels of assurance. If you think about that, technically speaking, when we provide lower levels of assurance, that usually means lower scope and work, the less work that we have to do. So we take auditors as our standard of being really, really high levels of assurance, and anything below that is going to be less work, but also less assurance associated with that. All right, we're done. we're done with the lecture. We're not done with audit reports. We're going to see those again, but I'm going to give you a little bit of a respite, and we'll be back for chapter 21 on Wednesday. Have a good day.